Hi, everybody. Welcome to this High Five interview. Today we've got Bill Ladd with us. Nice to meet you, Bill.
Good to see you, Dan. Appreciate you
Uh,
having me.
yeah, no problem at all, Bill. So I've been speaking to Bill for the past 7 months or so, and it's been really helpful for our development at Hive and kind of developing our internal but also external systems as well. And we recently started talking about possibly we should do a video together and kind of share some of his knowledge and kind of see if there's anything useful for the audience. So, Bill, I haven't introduced you beyond your name. But do you want to give an introduction to yourself, to your business, and what you guys do?
Yeah, appreciate it, Dan. And we'll just kind of get it out of the way first that my accent will tell you I'm from the United States, or they always ask, is it Canada or United States? So I have to clarify, I am from America. Dental specific firm over here. They reached out to you, I guess, earlier this year, Dan, and I've really enjoyed the interaction as we tried to learn from each other, kind of what we see over here, what you see over there. But to kind of go back and give you just a real quick backstory, how we wound up where we were. Started out like most CPAs do. We're CPAs over here, chartered accountants over there, to my understanding. Same thing. Went to school, and kind of as you were coming out of school over here, you kind of grab the brass, buckle or whatever you want to call it, your brass ring. You want to try to grab the most prestigious firm that pays the most money.
Mm-hmm.
I mean, I think my vision was pretty limited at that point. Probably had a little bit of entrepreneurial spirit, but it was really buried down deep within what my understandings of how public accounting is supposed to work. And again, you go to the biggest firm, you get paid the most, and you try to become a partner. And then it's this gilded path from there on. And that's what I did. I went to school in the Midwestern part of the United States, found a good firm, top 10 firm over here, more of a national firm. It's not international at this point, but it's a great firm. And I jumped off there, and at a bigger firm, it was very much focused on certain pursuits. You could do taxation, you could do audit of financial statements, things like that. They put me in audit. And so, I kind of started my career there, and it was a really good firm, and really enjoyed my time there. I was kind of promoted up the way I expected to, became a manager there, which is, what we call a couple rungs below a partner, again, which is kind of the end game for most CPAs over here. And I just got a random call out of the blue, and it was another smaller CPA firm, very much a local firm from my hometown, who was actually looking at expanding into the community where I lived in Springfield, Missouri, in the Midwest. And I think this is where I was kind of at that point, Dan, where I didn't have kids. I'd been at my job for a while. I knew I was doing okay, but really had no idea where my path led from there, whether I would become a partner or whether I was going to be stuck kind of in that middle management. Mm-hmm. And so I thought, after talking to my wife, that if there's ever a time to jump off and try something new, now was the time. Again, we had a house, but we didn't have kids, and we were just a little bit more free at that point. She had a nice job, and we were doing okay. So, I basically kind of made the leap back in 2005 to a smaller firm. One item of note that I think is always important to learn for people is I did really work hard to leave my previous job in a really good spot, kind of created that safety net. If this thing didn't work out, I could always go back there, and I think they would have taken me back. So that was kind of important to have that downside risk protection. But once I jumped over, it was just a totally different opportunity. It was a firm that I went from that had so much infrastructure and probably bureaucracy that it was almost too much, to a firm that had very little. And, you were really just, I hate to say this, it sounds terrible, but as a business owner, we were just kind of winging things. And I don't know if that translates over there to, but we were just kind of rolling with things, trying to figure it out as we went, building the plane that was already up in the air, so to speak. And so what happened was, over time, it led to some issues in the partnership that kind of festered. And this is one of the reasons I'm so passionate about trying to help dental partnerships, people in partnerships, because we learned a very valuable lesson that you can basically let these things fester and have what we call meetings after meetings and, cliques can develop. And that's what was starting to happen in his firm. My partner, Jared, who you've met, and I were part of a branch of this business. We were both partners. We had 5 other partners, and there was no vision. There was no alignment. There was no great leadership. We were all just kind of working together. And there was generational issues. And the worst thing about it was nobody ever talked about them. It was just too hard. You know what I mean? These conversations were just so hard to have out in the open. So we didn't. And they continued to fester up. And looking back, it was so unhealthy. And Jared and I will raise our hand and say, hey, we were a big part of the problem, because we didn't have the courage to stand up and say, we need to have these conversations out in the open. If we are all truly aligned, wanting to go where we want to go, problem is we didn't know where we wanted to go. And that was kind of a foundational component we missed. So flash forward to 2015, and these kind of things had been building up for a while. We hired a consultant, lived in San Francisco, actually was English. I think he was from London. Super nice guy, very smart, came in. And I think he realized right away what he was sitting on, which is a big powder keg that was ready to, to explode. And so really what he did is he kind of lit the match, walked out, collected our check, and went back home, and our firm blew up. I mean, and it was a very ugly, nasty split. A lot of friendships were broken, and a lot of trust was bruised. I kind of joke, for people who are listening to this who aren't CPAs, they may not appreciate this, but CPAs will, which is, this happened in January of 2015. In the United States, our tax filing season is really January 1 through April 15th. So we're very busy. And so we kind of worked our way through the first 3 months of 2015, negotiating a buyout, forming our own firm, and trying to take care of our clients. And it was a very stressful time, kind of a forged by fire. But what it did was it forced Jared and I to have a conversation, look across the desk, just like you and I are sitting here today, and say, do we want to do this? We had some scars on us. And so, we had to look at each other and say, yes, I trust you. I like you. I know what we can do together. I believe we can build something special, but the thing is, we can't do it the way we did it in our previous firm. And so that was our focus, is we were not going to do it the same way. And so I think through that mindset, Dan, that's really what started opening our eyes to the importance of leadership, the importance of structure, the importance of building a great product, but also having great people and taking care of them and helping them deliver it. Through that process, we kind of started to understand that being a generalist in accounting is not great. When you go from doing the books on a dentist to an architect to a contractor to an attorney to a manufacturer, they're all different. And so you're stretched really wide, but you don't have a depth of knowledge at any one skill or any one industry to help. And so that was one of our first realizations. We had to specialize, we had to niche out. And so we kind of looked at a couple things. We looked at real estate, which, over here, obviously is kind of a very volatile market. And, we kind of did that. We were doing pretty well in that, but it was extremely difficult to service as an accountant. Real estate developers, I don't know if it's the same over there, but they're extremely guns a-blazing. Let's go ahead and make a decision and figure out what happens next later. And so it was a tougher market to serve from our perspective. And we had always worked with dentists and really liked working with dentists. I think dentists and accountants are kind of, mentally wired the same way. I think they see the world the same way a lot. And so we realized that there was an opportunity to kind of enter that space over here as well. So in 2018, I think we got our first beta client where we kind of built out our service offerings for a dental client. 2019, we got our first paid client. And throughout the years, we've been actually able to kind of shed all the real estate and other non-dental clients we have and focus strictly on dentists and trying to serve them kind of all along their journey, which leads to you. It was to the point now where we're trying to obviously make connections and understand and have conversations with people who do what we do. We kind of have that abundance mentality, is that we can all learn from each other and there's plenty of work. Had done that many times with people over here. And I was just asking myself a question as a curious person, what is it like elsewhere? And I came across your website, was extremely impressed with the content you guys put out. I thought it was excellent, and I just kind of took a shot, Dan. I emailed you out of the blue. I'm surprised it didn't go to spam or you didn't just delete it immediately, wondering who this guy was. But was excited when you emailed back, and our first call, I think, was fantastic. And we just kind of build a relationship from there where we try to learn from each other. And, I think we're learning that dentistry has a lot of similarities, but there's some differences between our two countries as well. And I think it kind of helps us become more well-rounded in how we see the business of dentistry and how, we can serve our clients. I think we've learned a lot from each other. So I'm thankful for that.
Yeah, well, that was awesome, Bill. It's funny, we actually split from our previous partners in 2015 as well.
Yeah.
And we
one of
actually
those,
had 6 months as 2 different companies in the same small office together, which was weird. It was just really strange. But we kind of went into dentistry, but we were very green in the early days. And like you say, you kind of actually build up what you do, figure out how you do it, and then you gradually just really can add more and more value to the customer. So it definitely helps to be focused. So I think what we wanted to do today is start talking. Well, our first few conversations were kind of quite strange because there was a huge amount of similarities, not just between the issues you have with clients, but even as far down to your company structure, the different roles and the personalities of the people in those roles. So it was kind of really intriguing. But we thought if we could move through kind of the different segments of how a dental business operates and start talking about the different challenges in the different areas. So we thought this will be part 1 of a 4-part series. It's going to be based around, and apologies for people that have heard me talk about this a million times, but I'm just going to flash it up on screen. I won't give a full explanation, but this is what I call the abstraction model. So it's kind of a cross-section through a dental practice. I won't go into the deeper meaning except to say all of these things are happening or need to be happening in a successful dental practice at any time. Fee generation, the dentistry, operations, so that's not administration, keeping the doors unlocked and the lights on. It's actually proactive operations. Strategy is generally quite deficient in dentistry. That there may be kind of good meetings, but actually bringing those conversations into reality is quite lacking. And Bill and I think we can share some knowledge on how we believe you can approach that. And then finally, leadership and culture. So that's actually come a long way in dentistry, in my opinion. So I've been in the consultant's role for about 6 years, and at first it just had zero resonance with anyone when I started talking about it. But now, possibly thanks to YouTube and things like that, there's more podcasts, more videos just talking about the subject. So they're the 4 areas we're going to cover. Jump back to big screen again. But today we thought we'd talk about fee generation. So how dental production works in the States and the UK as well. It's a 2-way conversation, and the main challenges, areas for success, and anything we can learn. What I might ask you to do first, Bill, is actually tell us, how does the model work in the States? How are associate dentists employed, if that's what they're called, that type of thing.
Yeah, so there's different models, and I think this is one of the similarities between the US and the UK is, we have everything from an employee or a graduate who's now an employee for a corporate type entity, all the way up to somebody who owns a corporate type entity. So when you kind of think through the traditional path, what we tend to see is, and this is one of the differences is that we've talked about, it is when a dentist graduates from dental school, there is this huge range of what they're coming out with, Dan, as far as student loan debt. And I think there's a massive difference between what we see in the US and UK. We've heard that number probably on the bare minimum would be, 250K, maybe 200K, all the way up to 700 or 800 or 900K when you wrap in all the undergrad and grad, depending on the school. So US dentists, they come out and they are extremely, I use the word burdened. I mean, it really is. It's a tremendous amount of debt. And when you look at kind of the tuition cost from people our generation, it's just not even apples to apples. It's just kind of had this drastic spike in it that has made it where people have to think long and hard about what's important to them, Dan. And so a lot of people who come out of that, they become employees of a practice, whether that's a corporate entity, we call them DSOs, or whether that's working for another owning doctor. Mm-hmm. And so in the United States, those are what we call associates. And to us, associate is a non-owning doctor. Yeah. And they tend to come in, and there's people who associate their entire life. Mm-hmm. That's all they want. They like the security. There's a little bit, there's less upside, but obviously, you can kind of control your destiny a little bit because most of them are compensated based on production. Mm-hmm. That may be in the 30s typically, low 30s probably, depending on what kind of specialty they're in. Some of them, may make upwards of 38%, but those are typically maybe the oral surgeons or somebody who, does specialty work that's really high dollar, high value. Most general dentists probably shake out in the, low 30s, between 30 and 33 probably is where we tend to see most of those. Sometimes you factor in lab fees, sometimes you don't. But a lot of people kind of start there, and that's what they do. So then, as you're kind of factoring in the mindset of, I've got this debt and it's already feels a little bit cumbersome, but I do have a little bit of an entrepreneur bent. So now I'm going to start looking out, do I want to go out and join a practice or either form a practice, start a practice, or buy a practice? Mm-hmm. And so the point I'm trying to make is in the United States, you really need to have an entrepreneurial bent to even consider it. Uh-huh. That being a legitimate option. If you have a really strong entrepreneurial bent and you're very good at sales, a lot of people find that they can start up a practice, probably incur $500,000, maybe a little bit more, depending on the practice and what they're trying to build, and start a practice and get to work.
Is that from scratch?
That we call it de novo, from scratch. Yeah. That's a scratch start. And there's great people over here who help people do that. That to me, if that's something that somebody's interested in over here, I don't think you do that without hiring somebody to help you set up the infrastructure, because that's the beautiful thing about it, Dan, is when you start from scratch, it's scary, but it's yours. And if you set it up right from the beginning, it can set you on a path that's very different than if you inherit systems and processes from somebody you bought that are broken. So, mm-hmm. That's why it's intriguing to some people. But again, that's when you look at risk tolerance, they're on one end of the spectrum, because you're basically betting the farm, to use probably an American term, that you're betting on yourself, that you're going to succeed, and it's a far from certain bet. So, in that situation, they can kind of start up a practice there. Most of them will actually look to find a doctor who's looking to retire, mm-hmm. And they'll go out and they'll buy a practice. Over here, probably a lot of practices, shake out around the $800K to 1.2. Probably, if you look at a bell curve, the vast majority of practices are kind of in that range. Mm-hmm. If they start getting over that 1.2 to 1.4, then most of the time that doctor's probably going to sell to a corporate entity, a DSO. Mm-hmm. So, and sometimes it's too expensive for those single doctors to buy anyway. So they tend to buy kind of that $800 million practice, 1.2, somewhere around in there. Typical valuation in a doctor for doctor swap, maybe 70%, 80% current collections. It's just a different kind of model. We kind of look at actually a valuation from net operating income, but that's kind of getting into the weeds. So, they go by this practice, and then they like I said, they inherit all the systems, they inherit all the people, and sometimes that's good and sometimes that can be bad. So that's really where they have to start learning all of the segments that we're going to be talking about. And I personally think leadership is crucial. And that's, if we don't learn that quick, then a lot of times, we can get some problems developed. But that tends to be their initial step, that initial foray into ownership. Then they practice. Hopefully they're optimizing their practice, making great money. And then they look down the road, they're ready to sell, where they can look at whether to sell to another doctor or whether they want to take it to sell to a DSO or some other corporate type entity. If you have a good practice, good cash flowing practice, then at that point you have options. So that tends to be kind of how a typical life cycle of a dentist works over here.
Lots of similarities and a few little differences, actually. Key one being the first one being the percentage that you get as an associate dentist. So we firmly believe that kind of associates, it works much better ultimately for everyone, and there is collaboration in there if it's towards 40. But we're kind of heretics for saying stuff like that, to be perfectly honest. So in the UK, there's still some kind of understanding that associates get paid 50%. They don't really, and if someone will pay you 50%, they're definitely not investing in their business at all. You can pretty much still get 45% most places, and if you're a specialist, yeah, you'll probably be able to get 50%, but you will have to perform to kind of justify it. What would just a general 5-year qualified associate be taking home, roughly speaking? And I know there's a range, but
there certainly is a range. And when it's a percentage of production, I mean, a good one can probably be making 300,000 to 400,000. I think a 5-year out, you would theoretically expect that they could do around 80K production a month, get it close to that $1 million mark. And if they're getting paid a third of that, you can kind of do the math to see that they would be making probably into the 300K. And I think this is probably a big difference between our market and yours, is that it's probably no surprise to our UK friends that the Americans tend to be willing to part with their money probably a little bit easier. And so, production probably is a little bit easier to come by over here. Now, the caveat to that is when the money's flowing and times are good, that's easy to say. And a lot of accountants, a lot of dentists, a lot of people can look like geniuses because people are selling everything you treatment plan towards them. But realistically, we're probably going to see people ratchet back, with kind of the economy the way it is and some uncertainty. And so that we might see those production numbers get moderated down, which would mean some of those people may kind of come back down from that number. But that's probably a reasonable estimation of what a decent to good dentist could make after being there 4 or 5 years and really learning the craft. If they're willing to invest themselves to learn some more skills, some additional things beyond just kind of your bread and butter dentistry, they can typically do pretty well. So
what would if they were the owner of the practice and they paid themselves a market rate, so say 30%, or if they're a specialist, 38%, what would the EBITDA be on a $1 million practice?
Well, there's probably a difference between what it tends to be and what it should be. And I think this is kind of where a lot of people get confused. And I think you kind of have a formula that explains the same thing. Is if you look at how we try to present a financial statement to our dentist, is we put, their collections at top, and then we try to categorize their operating expenses by type. Let's say facilities, let's say, people cost, admin, marketing, all that. So we can kind of see, are we doing what we need to do, percentage wise? And so what a lot of people will see is they'll kind of get down to a certain net operating income and say, well, that's my profit, but they're not considering what they should be paying themselves for the work they do in the practice. And when you factor that in, their true profit's probably zero, and by extension, the EBITDA is probably zero too, or very low, because you got to factor in a reasonable owner compensation wage into that EBITDA amount. So what we try to drive doctors towards is, let's try to look and say, let's look at all of our operating expenses. Let's make sure they're in line. Let's get to a total net operating income, and then let's back out a reasonable owner's comp. And, if we can get that number to 20%, you have a really good practice.
That's similar. That would be our. You can get above it, but there's usually something unique about the business model that's happening there. But 20% is really kind of gold standard profit in UK dentistry. To be honest, if we see a practice that we haven't worked with that's at 10%, say, we kind of say well done, because it means you're doing a lot of things right already. And there's kind of, there'll still be levers to pull on, but it's heading in the right direction.
So Dan, let me ask you from a UK perspective, when you look at the 40 to 45%, that by itself cuts into margin pretty. I mean, that's a pretty big cut right off the bat.
Yeah.
So how do doctors work towards that 20% when a big cut's kind of coming off that just right off the bat?
I'll just quickly say before I do it, in other industries, it does work on the 30% model. So accountancy, law,
Sure.
stuff like that. Is that the same for you guys as well, roughly?
I don't know if I can speak to that. Accountants and lawyers, I mean, a lot of times they're more book of business driven, which is similar to production, I guess. This could lead to a whole nother conversation. We try not to look at it that way. We try to look at it as kind of one firm, and whether Jared brings in work or I bring in work, I really don't look at it that way. So we don't necessarily compensate ourselves that way, but there probably is some of that in the other industries.
It does limit growth in kind of in certain firms as well. I will say that if you're fixated on the production number. But yeah, so if they're paying out, let's say the average is 45%, it just puts a lot of pressure on the business. So in the olden days, basically pre-pandemic, like you say, in good economic times, it's easy to think you're a genius, and
that's right.
You don't, as a surfer, you don't want to mistake yourself for the wave. That's the thing. So everyone kind of should have done well in that last period of time. So you could get away with it broadly, just like you could get away with not having a good sales process. You could actually get away with never hearing the phrase EBITDA in your life, and kind of exit and get a decent chunk of cash and retire and be a massively successful business person. Now the kind of rubber's meeting the road to some degree. So one number that we've seen kind of just objectively change. So pre-pandemic, we do track a number called the cost to open a surgery. So it's basically how many clinical days are there, what are the costs, divide by that. That's the cost to open a surgery. And there's obviously outliers, but it generally came in at about £550. So that was a mainly private dental practice. But we've obviously got the NHS over here, which I won't go into because that makes things even more confusing. But broadly speaking, you're doing dentistry, you're selling dentistry, it costs you £550 to open a surgery for that day. The average daily yield, so the amount of revenue going through that surgery a day, an average ADY is what we'd call it, so what an associate is producing, is maybe £1,200. So they would get paid 45% of that first. The perception of the associate is the 55% goes in the owner's pocket. They don't understand it basically just goes on the cost to open the surgery, and there might be 50 quid left over. So basically that's where your profit went. But I suppose the margin was made if you sold high value treatments. So we'd say, get Invisalign, get an implantologist to come in, learn to do implants, and let's invest in marketing. And you could be pretty clunky about how you converted those opportunities once they came to your door. But your margin, your kind of costs are covered here, and then you just make margin on the stuff above and beyond. The problem has become that actually the general activity in the practice is now loss making. So let's say the cost to open the surgery has gone to £600, so the £50 has gone, but also there's kind of everything's more difficult. So it's just, whereas you've probably been in neutral all your career and maybe earning 150 grand as a principal, at neutral, you're working hard, but the business and the cash flow of your associates might have been in neutral, but you've just been getting paid as an associate basically for the period of time. You might be seeing that 150 grand is now 90 grand, and you're suddenly starting to get a bit twitchy because your business that was worth $1 million 3 years ago, people might be saying is worth 650 these days. And that's just a kind of a shift in DSO corporate demand. So 3 years ago, a corporate would have just bought that practice, no problem. It's probably to do with being a smaller market, that when any kind of purchaser comes out, it does have an impact on it.
Yeah.
So I've gone a long way of saying it makes it very difficult to make money because associates are disproportionately remunerated for what they get. It's not their fault. Culturally, everyone is told that actually, I promise you, Bill, I've like sat with hundreds of associates. They believe the 55% goes in the owner's pockets.
Yeah. Yeah.
They do not believe there could be anything, any cost scaling at that level. So I think it might shake out. I think what could happen is, so smaller practices that might be a principal and 2 part-time associates, I feel the only lever that principal is going to have to increase their income is get rid of the associates and do more dentistry.
Yeah.
And that's psychologically how a lot of dentists will work. That okay, and it's true. It's quite short term, but it is true. They'll get greater income there, but they'll be kind of damaging the future of the business.
Right.
So
it's, I mean, you're looking at the difference between at that point becoming an employee who's producing versus someone who maybe has a little bit more freedom of time. So a couple points, if you don't mind, I'm not going to jump into what you said there. This is one of the reasons why I think when it comes to the segment where we'll talk about leadership and culture, I think it's so important that, number one, the dentist understands the business of dentistry. And you've kind of walked us through your consulting and kind of some of the approach that you and Ross take to kind of help educate folks on that. That's huge. We tend to find over here in the United States that people go to dental school to learn to be dentists. They don't learn the business of dentistry. They maybe get one class. And so they come out, and I think things that we take for granted that they know, they just don't know. And so it's incumbent upon us and good accountants like you guys to educate and try to help them get that acumen if they don't have it where it needs to be. Because I think there's a huge opportunity is once you understand that, you start seeing how these margins work. I think it gives you an opportunity to really educate your team in a responsible way as to how the business of dentistry works, because that is a very common mindset of they kind of do the math in their head. Well, you're only paying me this. Well, that 55%, that's buying a Porsche, or that's playing golf, or whatever, whatever the advice is over there. But we know that's not true. And also incumbent upon that, that yield is also the stress that comes with being a business owner and trying to put food on people's tables. And that's not something that we take lightly. And our responsibility to our clients is to try to help them understand it, try to help them find ways to productively pass that information down to their team and kind of get their acumen. Because what we tend to find is when people are more dialed into what's going on and how the business is doing, they tend to be more engaged and excited. And once they're more engaged and excited, I think you tend to retain people better. And I think you tend to be able to recruit people because they'll feel that when you come in there. If you don't mind, I'll take one more pivot, because I think there's a big component that we really haven't touched on over here, just to kind of give you an idea of how dentists make it work too. And that's where hygiene plays in to the equation. And, I think a lot of times historically, hygiene has always kind of been a way to cover overhead. I'm not going to say a loss leader necessarily, but, an opportunity just to kind of have those touch points, get some production coming in the door. And
I kind of sometimes describe, sorry to cut across you, Bill, but I describe it sometimes as like a premises cost. It has to be there so you can do business. But it's difficult. We're actually working with other people because they believe it can and should deliver a profitable service. But it's often the case that we'll just look to manage it here because it needs to be there. Yeah, it's difficult.
Well, what's happened here was over the pandemic, there was a massive squeeze on the amount of hygienists. There were people leaving the field and getting out of dentistry entirely. Mm-hmm. And so there was this massive supply demand swing where hygienists were harder to find. And it was almost kind of like a free agent in a sport, where you're going to go where whoever pays you the most money. And that could mean leaving a position that you love, that you've been at for 15 years. And we were seeing that happening. So a lot of our clients, from 2020 to 2021 were drastically understaffed in hygiene. If they were staffed, we were seeing what they were having to do. And I guess that's questionable whether you have to, but they did pay their people market rates that 2 or 3 years before would never have occurred. So a really simple metric we like to look at, Dan, over here when we start out, because just as an aside, for these practice owners over here and probably over there too, is wages are always a great place to start, to see, are we out of whack in our margins, and if we are we underproducing, are we overpaying, or both? So what we like to do with our hygienists is to get production reports and see kind of what they're producing, and as a percentage, compare that to what you're paying. And so, what we tend to see, in a healthy business, you probably would think, that would be no more than a third, but we were seeing situations where people were paying upwards of 50, 60% of their production dollars in wages and benefits. Yeah. And so that takes a margin that was pretty tight already and really squeezes it down where it does truly become a loss leader. And so what was interesting side effect over here was a lot of associates were having to clean teeth and do hygiene work because they couldn't find it or couldn't afford that. And so a lot of people that I worked with took the long game on this and realized that once you kind of get somebody in at a wage, it's really easy to kind of raise them up a little bit, but it's really hard to bring them down. Mm-hmm. And so they were patient, and they just realized, we're going through a trough. Our numbers are going to look rougher. Our associates are probably going to have to roll up their sleeves. But at the end of the day, we don't want to overinvest in a position that could burden us with overhead for years that is not sustainable. And so we're slowly starting to see that pendulum swing back to where it's more of a normal sized supply demand curve on hygienists. And I think that's crucial for doctors to show some profit and really get to that 20%. Is you have to build out a model in our mind that has a reasonable base pay, but also has some good incentives to make them where they can make great money, but also allow you to kind of keep your expenses in check. So just an aside of how hygiene kind of works over here, if that's of interest to your clients over there.
Absolutely. There's a couple of points from that. So it definitely happened in the UK with hygienists, not to the same extreme. So the pay got recalibrated. Where it really, really has happened and is happening is nursing. So loads of people left the nursing profession. So minimum wage has gone up. There's demand. There's basically, we had. Did you have furlough in the States? So basically, people were paid not to work. Yeah. So it just kind of debased the whole workforce. So there was quite high-paying jobs with way less stress than being a nurse, which is a really tough job. So you can go and work in a supermarket and get paid the same amount of money and, right, and not have to deal with difficult dentists or patients or all of this stuff. So no one blames them. And actually, more or less every dentist I've spoken to believes nurses should be paid more. The difficulty we've got in the UK is the 45%. So we've definitely said you should really talk to the associates that it's not, everything's costing more. So if we want to get the best people, we've got to, we are going to have to pay them. Do you want to share in that? Can we reduce the percentage? And we've been doing similar things with marketing as well. And it does become more collaborative. And I definitely think there's an element that don't think because you're paying more, you'll get more as well. It's all the stuff you were talking about, Bill. You have to create a place where they're engaged and excited about their role. So it's definitely knocked out any profitability on certain businesses. But going back to how does someone get to 20% EBITDA in the UK, to be honest, it's a lot to do with size. So it sounds like there's a bracket in the UK market which might not exist in the same way in the States, where people wouldn't tend to exit. Some people would exit at 1.2 mil, but actually that's probably the first point where they're starting to make profit above and beyond. So we used to say, this is about 7 years ago, our kind of key marketing line was we'll help you reach the £1 million sweet spot, which was basically where your revenue is big enough, it'll take care of your fixed costs enough so you'll have some profit. Before that, it's basically going to be your dentist salary.
Yeah.
I was saying it's kind of gone to 1.2 now. It might have even gone to 1.5 to get that true profitability, just because there's unforeseen cost increase at the moment. I don't think we should design the perfect model around the cost base today, because anything could happen. More nurses could leave the profession, and nurses who used to be on £10 an hour could be on £20 an hour in a year's time, and you're not big enough to absorb that cost. So yeah, there's quite a few practices that are reaching that big EBITDA. Might be kind of 2 million plus. Single sites getting towards 5 mil. That does still happen here. And then it would probably be a corporate purchaser that was looking at buying them as well.
At that point, the individual kind of gets sized out to doctor swap. So see, this is interesting to me. And that makes sense. Volume sometimes is what you need to cover overhead. Mm-hmm. In certain industry, manufacturing, that's exactly what it is. You have to have certain volume to cover your overhead. So when you look at just first of all, how many do you know roughly how many dental practices there are in the UK?
11,000, I think.
11,000. Okay. Yeah. How many of those, or what would you say the vast majority of those, what would their revenue kind of be around?
So we get a biased view of the world just because of people that tend to select to get in contact with Hive are probably profiled more business orientated. I'd say your average practice in the UK is principal led, and will turn over between 500 to 700k. They'll be the vast proportion of the revenue. It certainly was the case a bit ago that was, we'd call it a lifestyle practice. So it's a great job. It's probably 4 days a week. You're probably paying yourself 10, 12 grand a month. In your peer group, you're one of the kind of richest people going. So to everyone's perception, apart from probably someone who's looking at the EBITDA, you're a very successful business person, an entrepreneur. Yeah. But actually, you've created a great space for you to apply your trade, which is great. That was actually what the model wanted before. We started speaking about scalable growth businesses, kind of saying, actually, you don't have to do any of this stuff yet, but if you did, there's massive returns about thinking about the outer layers of the abstraction, leadership strategy, ops, and kind of building that business that can grow with it. It's really hard to say how much of the market is those kind of 1 million plus. I actually wouldn't like to say. I'd just say say that there's an interesting phenomenon. I don't know if it will happen with you guys as well, but actually some of the most famous practices in the UK that win all the awards aren't necessarily the best businesses. So we don't actually know anything about dentistry, dentistry, that is. We just look at the business side of things. So some of the top performing practices I've ever seen are in kind of market towns in a semi-rural environment. Yeah. And you're thinking, hang on, why is it surely, so in the UK it's Harley Street, surely that's where the best businesses are. And it's just not necessarily the case. So for that reason, you never know. We got we did an analysis on a guy with 2 sites, and you never know what you're going to find, but he had a 18% EBITDA, and it was just like he had super lean staff costs. But so you never know I would never have predicted that at all. I would have said, yeah, big revenue, nice, probably doesn't make that much money. He gets paid well. Not the case at all. Super business.
Yeah, I think that's all tracks a little bit to what we see over here. And part of it is we're a bigger country, obviously, geographically wise. So we have a lot more dentists, but we also have a lot more competition. And so what you would deem probably from an outside perspective is some of the most desirable markets, let's say Los Angeles, New York, Dallas, they're also the most saturated. Yeah. And so to come into those markets, you would think, well, I just go ahead and open a dentistry office in Dallas, Texas, and I'll make a lot of money. It doesn't always work that way, because in the United States, people are also kind of strange with how they look at how they choose their service providers. And there's even geographical things like if you're in a city and there's a river that divides it, I'm never crossing the river, even if I love who I'm going to. So there's so many factors that say that you have to really stand out in those saturated markets, or you will be an average to below average practice. And earlier I said, the vast majority are 7 to 1.2. What I should say is 1.2 and lower, because there are a huge swath of people who are, I hate to say it, but just they've kind of created a job for themselves, and they may be around that same number, that 500,000 or 600,000, probably stressed, working, entirely in the practice. But once you start getting to that 700 or 800, then I think you start seeing, well, maybe there is more we can do, and that's where you start trying to work their way up. But I probably misspoke. Most people probably are, if you look at a bell curve.
Yeah, I mean, there's
lower range.
Some practices that we see where they're really, really low revenue, and you kind of take a deep breath and you need to figure out where to point them in the right place. Because Ross and I in particular, used to have a really bad habit of rushing to the answer and rushing to the advice. Like, there's things that we know probably aren't going to work out just because we know it, and we'd say, oh, don't do that, like you shouldn't do that, and we'd give the reasons, but if you're not in a place to hear the reasons, you're kind of excited about it. So when kind of places where you kind of sense some risk, it's our job to actually kind of build the relationship before this to get them to a place where we can talk about it. But it is there's challenging practices in the UK which may end up being all right, because they've probably got really low cost base as well. It's probably the mid-range ones that do need staff, and probably won't be able to afford to market. That's an interesting thing that I've been saying to clients for ages, that I'm hoping the cost of marketing goes down, because what happened post-pandemic is there was a huge demand for aesthetic treatments, so Invisalign, composite bonding, or everything kind of like that. And so everyone just started bidding on Google ads, Facebook ads, Instagram, and rightly so, and everyone made hay. I thought that would tail off as demand tailed off, and actually the leads are still out there. They're expensive, they're harder to convert, and I think that's what we were talking about earlier, about people just taking an extra second to consider any cash that they're spending. So actually, do I need to do this today, or could I wait till next year? That type of thing. So I thought people would be going, okay, I might just stop investing on that, because the last 10 leads that came through the door didn't convert, and they cost me however much to bring in. Still going, so it's still very expensive to market in the UK, just to get those bids, and you've got to be so much better to do stuff with them. So I don't know how that will kind of end up, but if you've got no margin already, you're not investing in marketing, you were kind of operating just off a regular patient base, your costs have gone up significantly, so you're now loss making. You've still got a valuable business, I will say, so there will be a purchaser, probably at more than 100% of revenue as well. At the even if it's loss making, they'll call it an owner occupier model. So unless you're going to exit, you might have to dig around and find your own cash to put back in the business to market and learn a whole new set of skills. So in very interesting times as to what's going to happen.
Specific to marketing, I think we saw the same thing over here. Again, post-pandemic, there was a lot of fiat currency, or whatever you want to call it, where there was a lot of money out in the economy, and people were spending it. And so as a result, there was a big emphasis on, let's try to get Invisalign cases, let's try to do implants. And what I've realized is that, marketing, there's a lot of people that take a very shotgun approach. And so, in my mind, marketing is all about driving new patients. New patients in America are what tends to drive growth in a practice, because they come in with treatment plans. If somebody's been with you 5 years, hopefully all the treatment plans are either in works or are done. So new patients are crucial to find the abilities to do maintenance work, maybe some of those value add like that. But a lot of clients were taking kind of a shotgun approach. And so they were driving new patients. So every month when we'd be tracking new patients with them, we'd be like, great, yeah, but they come in, but hate to say it, but they're terrible patients. They're not really looking for, or I should say this, let's say the phone's ringing, maybe not new patients, but the phone's ringing. Mm-hmm. It's not the kind of clients they want in there, the kind of patients that they want to work on and to serve and have a long-term relationship with. So a lot of it was just ineffective marketing. I know you guys, with what you do and the ability to kind of wrap marketing into a holistic plan to help their financial health, that's not a shotgun approach. I mean, that's kind of looking holistically of what are we trying to do? How are we going to try to hit our goals? What do we need to hit those goals? And how do we get there? And marketing is a major component. So when the economy goes south, a lot of people are going to say, well, we're just going to cut marketing. And I think you don't make that you don't make that decision glibly. I think you have to really study, is that the right decision? Because that's what almost everybody is going to do. They're going to look for ways to slash their operating budget, and marketing tends to be on the forefront. But is that the right move? I don't think it's as cut and dry as some people think it is. I think that done well, that's going to be a differentiator and a lifeline for you to help you get through some tougher times. So, marketing is extremely important. Over here, we don't try to put any kind of ratio on it of what you should spend. It all just depends on what you're trying to do. But it never in my mind should that be zero. And that's where you see these middling businesses who really are stagnant. They don't have any marketing. You don't see any advertising. You don't see any marketing. There's nothing there. And that's kind of the effect.
It's interesting because you're absolutely right. But kind of going back to me saying it was simpler in the olden days. Yeah. Like genuinely, there would still be margin in short-term ortho, whoever delivered it 5 years ago. So it kind of was okay. And if it created budget for us to actually figure out, and budget and time to actually figure out how to scale the business, it was great to get, you'd probably call it sugar rush of high value treatments coming through the practice. Whereas now Ross and my service is, we've got to be way more involved, not clinically, obviously, but actually talking about the bread and butter. So you could get away with an average performing associate in the past. Today, that average performing associate is loss making. So we need to know how many checkups are they doing. Well, they shouldn't be doing more than half a day of checkups, because when are they going to do their work? It wasn't conversations I really had to have before, because you could kind of build momentum by just getting revenue through the practice, then figure out the competencies and and often if you get that culture of growth, the associates come with it. Whereas now it's certainly, more focused about just making sure everything that's happening in there is moving in the right direction.
And this is why I'm going to sound very biased here, but to know that, you need data, in my opinion. And I feel one of the problems we tried to solve in the US, and one of the reasons why we exist, is there's people over here that in dentistry, you can make money in spite of yourself. And so they're running their business off their checkbook. I mean, literally, if I log on and see I have cash in the bank, I'm okay. Well, that's unacceptable. And especially as you're heading into an economy that's uncertain, you have to have good data. And that's where we found a really good niche over here of outsourcing bookkeeping to us, or somebody. I don't care who it is. I just want you to have good data, timely, that's meaningful. And if you don't have that, then I think you're always going to be playing from a defensive position and not really being able to look and see what are these numbers telling me. And yeah, I may have cash, but is it going down by 20K each month? That's a problem. So I think that there is some educational component that came over here, because a lot of people don't want to hear that messaging. But it's like you said earlier, the clients that seek you out, the clients that seek us out, I think they understand that. We just happen to find there tends to be a deficiency on the financial reporting, which probably will go in more an operational conversation we'll have. But that's why I think that what you guys do and your ability to kind of shepherd people along through these, somewhat uncertain times, and even in the frothy periods where money was free and people were spending it, people still have to make good decisions. And that's why I think, again, that's one of the reasons I was drawn to you guys, is just seeing your process, how you operate, the messaging you're putting out there. It's just important. And I think people need to hear it right now, probably more than ever.
Well, that's a great place to end. Thank you, Bill. That was awesome. Do you have any final words to say?
I just appreciate the friendship, Dan. I appreciate the opportunity to share this. Um, I'm excited to continue these. I think we just barely scratched the surface. My mind, we almost probably should have started leadership, because I do feel like that's where everything starts.
Yeah.
But I kind of like the idea. We'll work our way up, and maybe we can hit on some ops and kind of compare some notes and get strategy and leadership,
Brilliant.
as a way to kind of finish out. But I just appreciate the invite, and was happy to be here.
Cheers, Bill. Thanks very much.
Absolutely. Thank you, sir.